Hello, my name is David Burnett. I'm a CPA and a partner with Meridian CPAs in Indianapolis. The focus of my practice at Meridian is on small businesses and individuals with complex tax situations. In the second half of December of 2010, most of the tax laws and regulations from 2010 were extended for 2011 and 2012. I just wanted to provide a brief overview of the main points of that tax act. Since we do not know what the longer-term federal tax structure is going to be, I'm going to discuss a few ideas that can be considered over the next few years. The 2010 Tax Relief Act temporarily extends the 25, 28, 33, and 35% brackets through 2012. Additionally, the Act keeps the 10% tax bracket in effect for additional 2 years and eliminates the reintroduction of the 39.6% rate until after 2012. The 2010 Tax Relief Act keeps the child tax credit at the 2010 level of $1,000 per qualifying child, eliminates the reintroduction of the marriage penalty, and eliminates the reintroduction of the phase-out of itemized deductions and personal exemptions through 2012. The 0% long-term capital gains tax has been extended for individuals below the 25% marginal income tax bracket through 2012. This would include single filers with taxable income of less than $34,500 and joint filers with taxable income of less than $69,000. The 2010 Tax Relief Act extended several educational tax incentives, the most important of which for undergrads was the temporary extension of the American Opportunity Credit. Under this credit, taxpayers receive a tax credit based on 100% of the first $2,000 of tuition and related expenses paid during the year, and 25% of the next $2,000 in expenses for a maximum tax credit of $2,500 per year. This credit is good for the first 4 years of undergraduate education. For more information on this credit and how it can be coordinated with other education tax incentives, I recommend that you contact your tax advisor. The 2010 Tax Relief Act extended the provisions to allow tax-free distributions from IRAs to charitable organizations through the end of 2011. The transfers are limited to $100,000 per taxpayer per year. The planning point on this extension is that if the taxpayer is subject to required minimum distributions from their IRA and would like to donate funds to charity, they can direct a trustee-to-trustee transfer from their IRA to the charitable organization. The transfer qualifies as a required minimum distribution for that year, but does not get recognized as income on the individual's income tax return. The $1,500 energy efficiency credit available for 2009 and 2010 has expired and been replaced with a $500 lifetime credit. If the taxpayer has received more than $500 of credit in any prior year, no future energy efficiency credit is available. Additionally, there are specific per item limitations for the $500 credit as well. This is a significant change from the 2009 and 2010 credit limits. Due to a holiday in Washington, D.C., the filing deadline for 2010 individual income tax returns is April 18, 2011. As such, taxpayers have until April 18th to fully fund their 2010 IRAs and health savings accounts. If you qualify for a deductible IRA in 2010, the maximum contribution is $5,000. If you're age 50 or over, you qualify to make an additional $1,000 contribution to your IRA. If you have a qualified high deductible health care plan and would like to make a health savings account contribution, you have until April 18th to make your individual contribution of $3,050 or $6,150 for a family plan for 2010. If you're age 55 or over, you qualify to make an additional $1,000 contribution to your health savings account. In general, the 2010 Tax Act temporarily extended quite a few of the tax laws and regulations we've become accustomed to over the past few years. There are some changes and planning opportunities that could be considered through 2012. Each individual's tax situation is different. Therefore, scheduling an appointment with your tax advisor to discuss how the 2010 Tax Act will impact your specific situation in 2011 and 2012 could be a wise move as we start the new year.